So Mike, at the cash flow company, if someone comes to you and they're just not quite making it work with the DSCR loan, are there ways you can kind of finesse the situation, figure out how to, make it work for them?
Well, yeah, I think people have to look at all their options when they're looking at DSCR. Rents are increasing, but they're not increasing that fast. Property values are still high. So when rates are in the 7s or 8s, you got to really work your numbers and work your products. And what I mean by that is typically when you're out there, the DSCR has always been like a 30-year product, which means it's amortized over 30 years. So you price out a DSCR loan, and they will typically give you a loan that's based on a 30-year amortized product or loan. But there's other options out there, and those other options will typically give you the benefit of qualifying. Because what we see a lot of people do is they're just below the break-even point on DSCR ratios, which is 1 or 1.1, depends on the lender. So how do you tweak those numbers when rents aren't going to really change because the appraiser is going to look at them? Taxes and insurance aren't going to change. What you're going to have to do is either tweak your interest rate, and there's some ways you could do that, or look at interest only or a 40-year product and find a number that actually fits that property.
Okay, so tweak your interest, which we'll talk about, and then also the other option is potentially find a 40-year product instead of a 30-year.
Or interest only. Yep.
Or interest only,
Yep.
Okay. So really it's 3, right? Find interest only, find a 40-year product that could also be interest only.
Yep.
Or just tweak the interest itself.
Yep.
Cool.
So it's looking outside the typical 30-year box, because for the longest time, DSCR, that's all it came in, one flavor was the 30-year. But now it is more and more interest only. There's few, but there's more and more lenders doing 40-year products. There's even a few doing adjustable rates, which really don't help that much in this market because there's not that big a gap between fixed and 30-year. But interest only, 40-year definitely are ones that you should look at to make sure cash flow will equal. And we could go through an example just to show what that looks like. Because a lot of people come in and they're like, this property just does not qualify. You're going to have to either put more money down, or you're going to have to get that rate better, or get the interest only.
Okay, I think I'm understanding. Let's do some examples, and I think it'll click.
The example I have here is let's just say your net rents. When I say net rents, because typically on DSCR, you add your principal and interest, your taxes, and your insurance, HOA, and your flood insurance. But in this case, just to make it simpler, we're going to net those expenses out of rent. So we're going to just deal with looking at your mortgage payment. What's the difference? How do you qualify? So in this case, let's just take a rent on a $250,000 property or $250,000 loan that the rents are $1,725 a month. And then let's look at a 30-year product. 30-year product on this, we just priced it out at 7.65. So if our net rent's $1,725 and someone comes in and we do a 30-year quote, the payment's $1,774. So we're about $50 over break even. So that's not good for the client because they're not going to break even.
Right.
Unless there's some huge growth coming up. And it's not good for qualifying. Yes, there are other products out there if you go below 1, but then your rate shoots up. So that $50 a month in loss becomes $150 or $200 because your rate goes up.
Yeah, I remember talking about that where you said some lenders will do that because they see potential in the property even though it's not going to make money, right?
Yep.
But then you're going to make even less money. You already didn't break even, but now your rate's higher, so you're going to, it's going to be net negative for sure.
It's tough, and some people use those products like if they're trapped in a hard money loan, and it's better to lose $50 or $200 than $700 or $800.
Gotcha.
So there's a reason that people do those, or there's a big equity swing. But in this case, we're just trying to qualify for a deal. So if someone came to us for a loan and their rate is, like we said, 7.65, 30-year is not going to qualify. But let's look at an interest only. An interest only means for a certain period during that loan, maybe 5, 7, or 10 years, all you're paying is interest, and then it amortizes after that, or you can refinance it. But in this case, using the same rate, we use interest only, and the payments are about $1,594. So we've gone from $1,774 to $1,594.
Yeah.
Yes, you're not paying down on the property, but you get to a point now where the cash flow is, one, qualifying, and number two, you have $130-some a month in positive rents now.
Yeah.
And if your rents go up or something happens, you could still make some extra payments to pay that down, or you could just cash flow, because some people just like paying interest only because it's going to appreciate typically, and they want as much cash flow as possible. So interest only is one of those things you should look at. especially when you're trying to qualify.
Yeah, I would definitely be interested. Like if I'm if I have to choose between not making money and making money, that's why I'd be getting into the business, right?
Exactly.
I mean, obviously, like it's with hopes of a bigger payday down the road. But in the meantime, cash flowing is important. I think like it's better to have that than not.
There's no reason to get into this real estate unless you're creating wealth or cash flow, but hopefully both.
Yeah, 100%.
Hopefully your goal, what you want to do is ask, like, why am I in this? And hopefully you're in this to make money and now and in the future. So
yeah. So when you say creating wealth, you're talking about the bigger stuff down the road, like the payoff, the equity. Yeah, that's wealth, and then cash flow is right now. At least you have some positive, cash to work with.
In 30 years, 20 years, 10 years, when you pay it off, and that asset has now gone from maybe 300,000 to 600 to 900,000.
Yeah.
That's what you're creating. You're kind of creating that wealth. Call it your extra retirement plan of either that property's kicking off income or you're selling it and taking a lump sum too.
Yeah.
Hopefully 10 of them.
100%.
Why not do 10?
Yeah, it's crazy that more people don't do this really because it's one of those it's just one of those things where you've heard of somebody that bought a house for, $25K and then they went and they sold it for $500K. And it's like something crazy like that if they just had it for 20 years, I grew up in Colorado Springs and there are literally numbers like that went from like 25 or 30 20 years ago to like 400 now.
Yeah. I mean, and we saw it. We looked at a property just up in Copper Mountain 6 or 7 years ago, just a condo, and it's tripled in price. It was 300 some, now it's 900.
Wow.
And I also wanted to go what does a 40-year look like? So what is a 40-year mortgage? It is the same kind of loan. It's a amortized loan. It just means it takes longer to pay off, which means you're paying less principal. But in this case, using the same rate, 7.65 on the 250, your payments are going to be $1,673, a little over $100 less per month.
Okay.
So now you went from negative to positive, and you qualify.
That seems like
sometimes it's just getting into the property, getting into it, creating the wealth, and starting out somewhere, but making sure you qualify. You got to get in the game to win the game. So, making sure you get the best product is kind of what we're focused on. Focus on getting you the cash flow so you can build that wealth and cash flow.
That's fantastic. Is there any is there a downside to doing these loans that are interest first? What is it?
Like amortize
later?
Yeah, interest or amortized or slower amortization. Okay. Of course, you're gonna pay it down slower or not even at all when you're doing the interest only. The negative is you kind of stay the same on your loan. But if we've seen over all of our history as the property goes up,
right, then it's not really relevant because you're going to be be able to pay it off when you sell the property.
It's still going up.
Yeah.
It's just not going up as fast as someone who's paying down on it. But in different times, you have to do different strategies. In this kind of time where the rates are a little bit higher, get in maybe in 3 to 5 years, rates are lower again, and you can refinance, get a better payment, amortize it. Or we have a lot of real estate investors who just don't care about paying it off because they're holding
that's what I'm thinking.
Cash flow, take out as much as I can, keep the interest only, refinance it to another interest only down the line. That's what they just love to do. Is they love to get as much cash flow now because they don't care about spending money when they're in 80 or 90.
Yeah. Right. It sounds like the investor's mindset is like you've got to spend money to make money, but it's like you are positively cash flowing the whole time.
Yep.
So it's a smart way to do that instead of, I've heard sometimes people use that phrase to, justify silly decisions, but this sounds like a smart one.
There's a lot of people who've done this strategy of interest only. And I want to go through one other example before we go to of what we do to help people qualify. But there's so many people who use this example just to make sure that we can get them into a home. Because once they get one, then they get two, then they get three. And in 5 years, guess what? Maybe that home's gone up 50 or 100 or 200, 300,000, and they've created that wealth. Even if they sell it at that time and walk away with a couple $100,000, not a bad deal. You never guaranteed that, but if you buy in the right place in homes, there seems to be less and less inventory out there, so it's just going to keep increasing.
Yeah, I mean, from what I've seen in my short life so far, that's the most reliable form of investment. And I don't know much about this. I've been learning a lot from you, but it seems like real estate is just always doing this.
It's how, it might go down a little bit, but it's always, if you look over any period, decade or whatever.
It's an upward trajectory.
If you're trying to get in and out, it's not like a day trading thing.
Right.
It's the more of a long term. The other strategy is buying down your rate. So what this means is paying an extra point, which is 1% of your loan, to the lender to get a better rate. because a better rate would mean a lower payment, which means you'd qualify. So we see a lot of times where someone pays down a point. In this case, they drop from 7.65 to 7.35, and now they qualify. They don't cash flow a lot, but a lot of times it's just getting in the property. In this case, if they paid down 1%, their payment would go down to $1,722. Remember, rents were $1,725. A 1-to-1 ratio works, and they qualify now. So that same property, someone wants it amortized. There's different groups of investors who have different reasons why they're doing it. We have a smaller group, but there's a group out there who buy properties more for the tax write-off now. So they can, maybe they're making too much W-2, whatever. They just need some write-offs now with all the depreciation and stuff. They don't really care about the cash flow now, but they want to build an asset for later. So when they're done with their business, they can move into having 10, 20 properties free and clear, but they don't care about cash flow right now. They just want to get into the properties because that tax write-off will put them into a different tax bracket. They pay less taxes, they keep more of their money, and they build wealth over time. So the three things is look for interest only, look for a 40-year, and look to buy down your rate, because a point to get into, like in this case, if it's a $250,000 loan, paying another $2,500 to get into a property that could create $50,000, $100,000, $200,000 in net worth, is it worth it? And typically it is.
Fantastic. Look for a 40-year, look for interest only, look to buy down your rate.
Correct.
Okay.
So when your properties are tight as far as, qualifying, look for those different products and talk to someone who knows what they're doing.
Awesome.
Great. Thanks, Michael.
Yeah. Thanks, Mike.